So today we're going to talk a little bit about the essential framework for real estate investing. And in some senses, you could say this is the essential framework for investing in general. And like I've heard you say before, it's a three-legged stool. It's mastering that strategic vision, it's balancing risk and reward, and it's excelling through execution. And without any of those legs, investing becomes challenging. So maybe you could speak a little bit about mastering strategic vision and what that means and why that's important.
I'd add on to the first thing you said, which is that when you think of a three-legged stool, it's an important analogy. It obviously can't stand with two legs or one leg. And it's like, well, why not four legs or six legs? Like, well, how many legs are on this stool? But the things we're solving for really are balance, stability, and purpose. Balance being like diversification, all your eggs are not in one basket, like you have a plan. Stability being like there's the ship can support itself, the stool can support itself, there's guardrails. This is really risk management. And purpose, like, where are we going? Why are we doing this? And how are we doing this? So let's talk first about the idea of managing strategic vision. The first thing in doing this is seeing beyond the deal. Like investing is so easily one deal, a deal, the deal. But strategic vision is seeing beyond the deal to see the context. Like, what ocean is this boat floating in, and what are the seas ahead and behind, and why is this particular boat going to float well in this particular ocean?
And being able to look at the broader context, look at more macroeconomic factors and the broader market dynamics, because those create that framework that allow you to then execute or identify a particular investment. So it's almost like the guardrails, or rather the lens through which we view the world. Mm-hmm. It's like the strategic framework is the binoculars that allow you to then zoom in on the individual opportunity because you're looking through a particular set of lenses.
Someone said it's the art of long-term thinking in a short-term world. Like we're all driven by our need for short-term this or that, or there's an immediate need all the time, and that won't go away. But how do you place that in the context of a long-term world? How do you see the long and the short and the middle? Another way to say it is, how do you see sort of patterns in chaos? And how do you see the patterns that have held true for you based on a career of investing? I'd throw that back to you, but how do you particularly, Ryan, see patterns in chaos? And how do you do that based on your career and experience?
Patterns in chaos are almost like looking at a river where there are all these eddies on the side, but you're trying to focus on where is the river going. And I usually rely heavily on my experience and my intuition that has been developed over time, because that experience and intuition, using the river example, that's the fisherman that understands based on this flow, based on this marker, I know what's going to happen next, or I know where this will evolve. So I think the anchor to identifying patterns in the chaos is experience and the conviction that we've developed over time. So how do you see patterns in chaos?
I really enjoy the idea of Warren Buffett saying that the optimal time period for investment is an infinite time period. The idea of compound interest, and in real estate, there's a lot of opportunity for compound interest. When you make a decision, you have a chance every year to grow NOI in certain ways. You have a chance every year to see the market and develop in certain ways. You have a chance to build new information into your existing framework year over year over year over year. If you need to, you can move on from an investment. But when you start, you aren't setting something in motion forever. You are starting with something, and then you are going to be able to add in new information to try to move that NOI higher, to try to move that return higher. Especially for us, we tend to invest in unflashy markets. Like we're not buying this hot stock or doing this thing. It's like, no, we're buying 2006 vintage apartments, townhomes with garages in this secondary market where there hasn't been any new supply in 3 years, and it doesn't warrant building any new supply. It's like we pick our pieces of conviction. They're unflashy, but they're stable, and we map out what we believe the growth to be, and then year over year we get new pieces of data to help bolster our conviction and the opportunity there.
Well, and I think we've been rewarded with that particular piece of vision, which is this idea that these markets, broadly speaking, are overlooked. They're underinvested, which also means there's more limited competition, which also means it's lower risk to be investing in the market because you don't have as much competition in the market. So in many ways, the strategic vision also helps create safety in investing because it's around a broader framework, a broader thesis than an individual investment.
In many ways, with real estate, patience is the killer instinct. Real estate's not a short-term business. Real estate cycles take a very long time, sometimes over a decade, often over a decade. Mm-hmm. The point being is that there's not going to be specific up moves or down moves. If you have a piece of conviction about a specific market, you have to have the patience to wait until the right asset aligns with the right time in the market, which aligns with the right part of the market cycle. So when it talks about mastering vision, vision really speaks to seeing what's next and what the long-term piece is. And so the first leg of the stool, mastering vision, is about having the ability to see long-term based on data and experience, and have the patience to buy and to sell based on a long-term vision. What about risk and reward? How would you speak to the second leg of the stool?
Yeah, that is the perennial balance. Is as we've spoken about before, risk is inherent in investing. The reason that one earns a return is because they are taking risks or perceived risks associated with that. And so there is always this balance and this push-pull between risk and reward. I think going back to the idea that our experiences inform spotting patterns in chaos, our experiences also inform how we view risk and reward. I look at the fact that we were founded in December of 2008, about 3 months after Lehman Brothers collapsed. And so we, in retrospect, had this wonderful learning experience of going through this incredibly traumatic time in the market. But it gave us a maybe a different risk tolerance when it comes to debt. We saw that bad debt makes good borrowers make bad decisions. And so we learned from that we just don't have the same risk appetite as others do when it comes to debt. And that has become an important part of our strategy as a result. So I think experience informs that balance between risk and reward as well.
I think we're great at managing predictable risks. I think where people get into trouble is that most risks are sort of unpredictable. The 2008 financial crisis, COVID, office demand changing based on work from home strategies. Recessions are usually poorly predicted. I mean, at this point, we've been waiting for the recession that hasn't come for 5 years. I mean, there was the COVID recession, but then there's supposed to be this other recession, then there's not. It's like, it's really important in building a resilient portfolio to have a portfolio that's built, that's diversified in the right way amongst the right assets, that's capitalized with the right amount of safety and cash flow and upside to deliver on the promise without needing 5 things to go exactly right. And in real estate, there's often many slow cuts to death where, your basis was great, but your asset was a little obsolete. Yeah, that market was a little off, but it was good this time, but then it wasn't. That recession you weren't planning on started to happen. That unpredictable event, I mean, as we speak, half of Los Angeles is on fire. Insurance costs changed. We live in a dynamic, unpredictable world, and you must build portfolios for upside, but also safety.
Another word for reward is opportunity. Risk is the fact that losses can occur, the fact that bad things can happen, And opportunity represents the ability to take advantage of some unique aspect of the market. And really, as an investor, our job is to double down on or particularly exploit the areas that we have high conviction around and that we have a high level of experience and control. Where we start to get more uncomfortable is where we're doubling down on some aspect that we can't control or something that we don't have a particularly high experience level or conviction around. That's where we get more cautious. And so I think as an investor, part of that balance of risk and reward is being able to recognize where you as an investor are well suited. Because where you're well suited, those are areas where just by definition you're reducing risk and you're able to take advantage of that opportunity. And on the flip side, recognizing where your unique strengths or capabilities or experience are not well suited and the risk that inherently comes with that.
I think it's really important to know who your customer is. Real estate exists because humans have a need for shelter or to distribute products they exist to serve humans. On the other side of real estate, maybe with the exception of data centers, although those exist to serve humans too. But on the other side of real estate are humans who have a need that the real estate serves. And it's this capital intensive, large, immobile property that serves a human need. And I would add that I think it's important to see how the humans you are serving, how their needs are changing, how technology is influencing what they want, how their lifestyles are changing, how work trends are changing, how family dynamics are changing, and to both understand what their needs are now and to understand where their needs are headed in the future and to be in front of that with the structures that serve those needs. And it's easy to look at what worked, say, tall office buildings, or it's easy to see what did work and assume that the product is the building. But you can get out of line with understanding that the building exists to serve the customer, and if the customer changes, the building won't be needed in that way anymore.
You mean like indoor malls? Another great example.
Or outdoor mall.
Yeah, yeah, name it. So we've talked a little bit about balancing risk and reward as one leg, having that strategic vision as the second leg. And the third leg that we wanted to talk about is execution and being able to use execution to your advantage. And I think, we're fortunate to be working in the real estate space. It's our particular part of real estate is often called real estate private equity. And when I think of that, what I think of is operating business. Private equity invests in operating business. And what I think about is control. The beauty of the investing that we're doing is we are working with a physical asset and a thing that we can distinctly change the outcome of. Very different than stock market investing, where it's much more focused on making the right decision on investing in a particular company than it is on any ability to influence that outcome. So when you think execution, what do you think about?
Creating value in real estate normally has a couple of traditional hinges. NOI and exit cap rate are your two big ones. So you're working to grow NOI and you're working to sell at a time when cap rates are either similar today or better than today. But you're having to call out 5 years in advance what multiple or what cap rate this real estate will sell at. And so, yes, that's known and that is execution. But one thing to say here too is there are these hidden drivers of value. Everyone knows those hinges. But as you look at, like, why did that company do well and why did that company struggle, or why did that seller not execute well? So much of this comes down to other things we've been talking about, like the psychologies of risk and reward, the ability to lead a property.
Culture.
Like, did the property become a better place? Like, a property serves humans, but if you're a jerk and you're hard to work with and you don't invest in serving the humans will go somewhere else. They have other options. Your NOI will struggle. So leadership is one of the biggest hidden drivers. Another might be capital structure, managing your debt and equity in such a way that your hard stops on buying and selling are aligned well with the market. Also having the right amount of margin. There's always pushes and pulls in real estate where there's always debt that's coming due, or tenants that are coming due on their leases. There's always these pushes and pulls it's easy to land in a spot where you have to make suboptimal decisions. The challenge for all of us in execution is to have the right amount of margin to maximize return and safety at the same time.
Yeah, and I think a big part of that goes back to what we were talking about before, this idea that you're pursuing opportunities that are most in line with your core competency, with your expertise, with your strength, because that is the area where execution in some ways becomes natural, or it becomes self-evident. When we deviate from those core competencies, that's when execution struggles, because we're now trying to learn a new thing. We as investors at times will intentionally move a little bit out of our core competency, but part of that risk and reward balance is recognizing that, hey, we're executing here and it's not quite what we normally do, and so I'm going to factor in a greater risk exposure here, and I'm going to maybe minimize some other aspects of that investment. I think of a couple investments recently where maybe there was a little bit of a self-storage component, or maybe there was a little bit of an excess land component, and areas where they're adjacent, they're adjacent to what we do, but we also recognize that they're a little bit outside of our core competency, and so we factor that in as we go to execute on those investments.
I'd add too that there's sort of a Disneyland effect, and the Disneyland effect is, Disneyland, in Southern California was built in the 1960s, but when you go there, the attention to detail is tremendous. Those old fence railings seem to always be newly painted. The landscaping is always excellent. Like, every detail is well thought through, and there's some intangibles to that. Like, you might not notice exactly what happened, but you feel the quality. And so execution optimally looks like extreme attention to details, both big and small, both in front of the scenes and behind the scenes. It's not just how the property is, but how your organization is run. Are the people who are answering the phones, number one, when people call the organization, does someone answer the phone? And number two, are they happy to talk to you? Are things well logged? Are complaints and challenges dealt with quickly? Is there love and compassion behind what happens? All of these have an additive effect or a negative effect, and so the details matter.
Yeah, and in real estate, let's be honest for a moment, property management is not a sexy business.
No.
It's not a business that people are dying to enter, but we have built that core competency over time, and we have seen such great value in our ability to execute as a result of that we wouldn't trade it. And we're willing to take the kind of challenges and unsexiness associated with property management, because we know how that influences our ability to execute.
Adding on to that, there's like perspective and position. And what do I mean by that? I mean, position is, hey, we run a property management business. This is how we do it. If there's an issue, this is our standard response. And then there's perspective, like, all right, Mr. or Mrs. Tenant or whoever, help me understand what's going on. And remember, there's a bunch of psychology there too. They might just be frustrated and need to be heard. That's probably half of it.
Yeah.
But it's the right amount, especially as you scale an organization, of having the right people who can both have position and perspective. They have a standard way of approaching things, but they also, number one, can cover that with care and love. And number two, know when to stand up and say, well, normally we do it this way, but this is a time to do it this way. And that's a fine balance.
Yeah. Well, this has been a great discussion, and just to kind of recap again, the three legs of the real estate investing, or arguably the investing stool for us, are having that strategic vision, being able to balance risk and reward, and being able to execute successfully on the investment.